Hi, everybody. We'll give it about a minute to let everyone come in and then we'll get started. Alrighty, we'll go ahead and begin. Good afternoon, everyone. On the behalf of the National Glass Association, my name is Alicia Mitchell, and I'm the Senior Operations Manager, and I'm joined by my colleague, Lori Cohen, editor of Window and Door magazine. We're grateful to have you with us for today's Thirsty Thursday webinar, where we'll be welcoming back Chris Beard from John Burns Research and Consulting. Before we dive into today's session, I'd like to remind you to check out our upcoming events, which you can also find at glass.org/events. Now, I'm excited to introduce my colleague, Lori Cohen, editor of Window and Door magazine. Lori brings 19 years of experience in editing trade publications for the construction industry, and she's been with NGA for the past 6 years. Lori, I'll hand it over to you to share a little more about what attendees can expect from today's session.
Thank you, Alicia, and thank you to everyone for joining today's webinar. Before we begin, I want to call everyone's attention to the Window and Door Top Manufacturer Survey and Report. This link, which we will share in the chat shortly, is open to any North American manufacturer of residential fenestration systems. We encourage you to share your information for inclusion in this comprehensive list. We're also seeking high-resolution photos of manufacturing processes, one of which we will choose for the May-June cover shot. Please reach out to me directly with any questions. But back to today's webinar. I'm happy to once again introduce Chris Beard, Vice President, Building Products Research at John Burns Research and Consulting. Chris is well-versed in the dynamic environment surrounding building products, helping clients and partners understand trends and inflection points within the broader building products and housing industry. In addition to the Window and Door Market Survey, which you will hear the results of today, Chris leads John Burns's monthly dealer survey, as well as a quarterly survey of structural component manufacturers, plus he monitors public building products companies' earnings. We're well over a year into this quarterly Window and Door Market Survey, which continues to grow and offer more insights with each iteration. Chris, take it away.
Very good, thank you. Let me share my screen really quickly. And I will share this. And the slideshow. Okay, so great to be back with you. Thank you for the intro. So we're going to continue with a similar format that we've had in the past. We're going to talk about the macroeconomic backdrop in 2025 for housing. We'll get into some what we're seeing in the new construction market, as well as the repair and remodeling market. And then, as Lori mentioned, some key insights from our latest Window and Door Market Survey. We have the fourth quarter 2024 results. Obviously, we're not through the first quarter yet, but we've got some insights and some forecasts that the participants shared with us. And then finally, we'll wrap up with some takeaways, and we should have some time for some Q&A. So with that, we've seen a lot in the news about what's been going on since the administration change, and what we're seeing near term is we see downside risks to the economy and housing in general, really due to policy and financial market uncertainty. There's a lot of uncertainty in the market around tariffs, so we're going to go into that as well, and geopolitical tensions. And so what we heard from the Fed yesterday is kind of this continuation of wait and see mode. So, they left interest rates where they were, but the bond market is expecting mortgage rates to remain high this year. The good news is that in the minutes that they did say that they're penciling in 2 additional rate cuts this year for now, with obviously the dual mandate goal of maximizing employment and lowering inflation. But there is some belief that we could see a return to stronger inflation due to some of the policies that have been enacted, specifically around tariffs. Recent employment data is painting a relatively clear picture of the labor market, but there are There are some layoffs from the federal government that we expect to see, and they're not yet reflective in the numbers. So we're going to be looking at the labor market data in the coming months to see what the labor picture looks like. But for now, consumers are a little bit hesitant around the labor market, and it doesn't seem as robust as it was maybe this time last year. And then really on again, off again tariff and trade policies are freezing the housing market. We're seeing that in new construction. We're seeing that to an extent in larger repair and remodeling projects. The policy of tariffs are on, then they're off and on again, and now they appear to be on again beginning April 2nd. That's really keeping a lot of people on the sidelines. Home builders have higher unsold inventory, and that's preventing new home starts. So this is kind of like blocking out the housing industry right now. And again, what I said, we perceive to be in like this wait and see economy based on policy decisions and geopolitical tensions. And this is best reflective of the Economic Policy Uncertainty Index. So this is an index that's taken based on news articles around the administration. And you can see there's pretty significant spike in policy uncertainty, not seen since the early COVID years. And this, I just have a snippet from an article from the Wall Street Journal this past weekend, and it really sums it up and says consumers and businesses are sending distress signals as economic fear sets in. And I pulled this quote out and shows that the sour mood is starting to show up in key data. Consumer spending in January had its largest monthly drop in around 4 years. And we can see that at the bottom that home improvement expenditures were down 2.7%. So we see consumers are worried about losing their jobs at a record high at levels not really seen since recessionary periods. And a record high share of consumers think that business conditions are worsening. And that's reflective in consumer sentiment, which just came out too. We can see consumer sentiment is declining, and it's really declining broad-based. Households making more than $100,000 a year, as well as households making less than $100,000 a year. Consumer worries about losing their jobs are prevalent, and that's playing into the overall economic condition that we're seeing today. We've seen a lot of stock market volatility too, again, around this uncertainty around trade policies and what's actually going to happen to the economy. Bringing it back to the building products industry, as Lori mentioned, I head up a monthly dealer survey where we survey lumber and building materials dealers on a monthly basis. And we just got the results in, published them this past Monday. And we can see that building materials dealers reported an 8% year-over-year drop in building materials orders. So that's a very significant drop, the largest drop that we've saw since March of 2023. And so that's sending concerns. These orders we measure the orders by product category, and we can see for the first time in survey history, we saw negative order growth across all building products categories. Total orders were down 8%, but large declines in some of those mid-stage categories like roofing, decking, railing, siding. A lot of this is seasonality too. I will temper this by saying we did have some weather events in February that contributed to this too, but the order declines were broad spread. And I'll get into some of the reasons why here in a second. And we also measure these product order growths by stages of construction. So we look at products that go early stage, that's more indicative of housing starts, so like foundations and framing, so lumber packages. Then mid-stage are kind of those building envelope pieces that seal up the building envelope. So it's windows and doors, insulation, siding. And then later stage are those things that kind of finish off the interior, such as drywall, kitchen and bath cabinetry, decking, railing, and millwork. And we've seen for the first time that all product categories are showing negative order growth on a 3-month average basis. So that's kind of indicative of where we think the housing market is headed. We can see previously upticks in early stage, those dark blue lines, then correlated later on to upticks in order growth in mid and later stage. Obviously, a home is started, then as it moves through the construction process, we see growth in those other categories. But the fact that all 3 product categories are declining year over year gives us some signals that we think that there's going to be a soft patch in home building for the next few months. We also asked dealers to rate strong demand. So they list out their demand by customer type, and it's weak, normal, or strong. And this chart highlights those dealers, percentage of dealers that showed with year-over-year comparisons that rated categories as strong. And the strongest category is custom home builders. So we're still seeing resilience in that area. And I'll go into that customer type here in a second. But what really is shocking is, and we've seen this the past couple months too, is really continued weak demand from production and tract home builders. Production builders are just slowing starts, and dealers are not reporting very strong demand from this customer type. We also ask, what are the biggest concerns? What are the things that's really blocking their business or preventing growth? And we ask them from their standpoint as well as from their customer's standpoint. And the blue bars indicate what building materials dealers say their biggest concerns are. And the green is what their builder customers say. But both of them said tariffs. Tariffs are the biggest concern. The wild card around, what's going to happen with tariffs? What price increases can we expect? Just the uncertainty around, like I said, the on-again, off-again tariff policy, that's their biggest concern. Labor, to an extent, we did dig into this a little bit deeper, and we said, is it because of the immigration policy? And it's not really. It's really around labor availability as a whole. But for the builders, the second biggest concern is unsold inventory, the amount of finished homes that they have that they're just not able to move, and that's in turn causing them to pause new housing starts. We've done quite a bit of work on tariffs, and so we kind of ranked everything by the share of imports across several different product categories. And I just have, for illustrative purposes here, plumbing fixtures, small electrical appliances, hardware, and then major appliances. And you can see the share from Vietnam, Canada, Mexico, and China, and then the rest of the world. And you can see the bigger chunk from plumbing fixtures and fittings, and then small electrical appliances are from China. They're obviously going to be impacted by the tariffs, but then other categories are more susceptible to Mexico and Canada too. I didn't show dimensional lumber. Obviously, a big piece of lumber that comes into home building comes from Canada. And as things stand today, effective April 2nd, that will be subject to the 25% tariff. Again, we've been there before. We've seen that the past 2 months. They haven't really taken hold, but for now it seems like they're still in place. So that is going to be a concern. We also asked dealers what their expectations are for price increases for full year 2025 is going to be, and we've seen this creep up over the past several months as the threat of tariffs looms. And they rate the highest likelihood of price increases be up 11% in dimensional lumber and then 9% in wood panels. Again, that's really driven by heavy exposure to Canadian imports. But they're expecting an inflationary environment across most product categories. The lowest is at 3% in kitchen and bath and cabinetry, but dealers are expecting price increases just due to the tariff impact. When we look at immigration, I want to spend a few minutes on this, and we've got a couple different sections on this. We've seen border crossings slow dramatically at the end of 2024 and 2025, just due to more restrictive U.S. border policy. And you can see some of the timelines that we put in there. In 2020, borders closed due to the pandemic. Then we saw increased immigration, looser policies in 2022 and 2023. And that extended into early 2024 when Mexico began intercepting and detaining immigrants, and then U.S. policy changed, stricter criteria for border crossers, and then finally tighter immigration policies with the new administration. So we've seen border crossings slow dramatically, which we think is going to impact the construction market disproportionately. We can see labor-intensive residential construction occupations really have a higher share of foreign-born workers. There are several measures out there around undocumented workers, but by very nature, undocumented means undocumented, that there's not a good measure of how many illegal immigrants work in the trades, but we do think it is a disproportionate number. I will say that we've done a lot of research in talking with our dealers, talking with home builders, talking with contractors, if they're seeing broad results from immigration crackdowns and ICE raids at job sites. And we're hearing anecdotes about that. So there are anecdotal evidences in certain cities where these are taking place. But on a large measure, we're not really seeing the impact, and our home builder and dealer and contractor customers are saying that it's not material impacting yet. But again, we're only into mid-March now, and this has only been in place for about a month and a half. So we'll see how this does play out. But regardless, we think that U.S. population is slowing from this immigration slowdown, as well as fewer births. And these are our forecasts on population growth out to 2034. And you can see U.S. population growth is decelerating. We do anticipate it decelerating. And that's primarily driven by decelerating U.S. births, increasing U.S. deaths, again, just because of an aging population. And then we expect to see declines in U.S. international migration, and then working age population growth is also decelerating and remaining relatively flat. And so what that means is we're going to see decelerating household growth, and that in turn leads to U.S. homeowner growth. But regardless, there still are positive demographics to housing that we're going to be highlighting here in a second. But we're seeing decelerating population growth, which is really going to, in fact, is going to affect housing demand. So we see that this tighter immigration policy, as well as an aging population and relatively low birth rates, are going to impact where we see population growth. And you can see it kind of decelerating through 2028. And then accelerating a little bit into 2020 through 2034, but still well below levels that we've seen in decades. And so that's going to have a material impact on housing. So now we'll go into some new construction insights. Those of you that joined me before, you know that we do a monthly survey of home builders, and we survey roughly 20% of new home sales each month. And we ask them things around their new home sales, their new home starts, what they're seeing from a pricing perspective, incentives, building materials costs, etc. And so this chart shows new home sales, and we measure this at the community level. The reason we do that is because sales per community are relatively even across the country. So a national number doesn't really give a clear picture. The national number that the census reports, because there obviously are pockets of growth and pockets of weakness. And so we ask home builders this at a community level. And so we can see in February, they averaged about 3.1 net sales per community. That's down 6% year over year, but still 24% above the February average in what we call more normal years from 2012 to 2019. So taking out that COVID boom and then the bust cycle that came out after interest rates started to increase, we kind of leveled that out for 2012 to 2019 as the more normal years. And we are down year over year in new home sales, but still above the long-term average. From a starts perspective, it's down 15% year over year, excuse me, yet still above the 12% February average from 2012 to 2019. And if we look at that in a more easily digestible chart, we can see that looks like, it's down 15% after really strong growth in 2023, which came off of really slow growth and declines in 2022 following interest rate increases. So once builders figured out the rate buy down, once builders figured out how to offer incentives, it really spurred new home sales growth and starts growth in 2023 leading into early 2024. But then since 2024, we've had that uncertainty around interest rate cuts, and then uncertainty around the election, which really caused declines. And we're continuing to see an acceleration of new home starts because of this uncertainty. When we look at completions, we think completions are really interesting because it gives us insights into backlogs. It gives us insights into cycle times. And we can see on a trailing 12-month basis through January, multifamily completions rose 31% and single-family completions rose 3%. So couple that with slowing starts. We're expecting to see continued declines, significant declines in multifamily, yet there still are a number of units under construction in many parts of the country. And while starts are down, the cycle times, which are vastly extended for multifamily, are leading to those units that were started a couple of years ago are still under construction. And we're seeing those units come online. Those completions are increasing, but single-family completions are increasing too. One reason why builders are really pausing starts right now, what we've been seeing is the level of unsold inventory in various stages of construction. This chart highlights 3 different areas. So those are completed finished inventory, the green is under construction, and then purple is the permitted but not yet started. And I drew this red line at the bottom because you can see the increase in completed unsold inventory is at levels that we haven't seen since 2009. So the inventory levels are increasing. Part of this is by design. Builders are realizing that the continued use of incentives and mortgage rate buydowns is an effective tactic to spur new home sales. So builders are consciously having higher percentages of spec inventory. But the levels that we're seeing that we haven't seen, really since 2009 is what's causing builders to say, as traffic has slowed, as they're seeing new home sales slow, they're a little bit hesitant to start new projects. And that's why you're seeing some of that growth in the purple areas at the top, permitted but not yet started, because of that unsold inventory. And so we're hearing from builders, they really want to get some of this unsold inventory off the books before starting new projects. But we like to say that new home market conditions are not uniform. We have consultants and boots on the ground in most major metros across the U.S., and we rate market conditions in each metros by very slow, normal, strong, and very strong. I will say, ideally, normal. The yellow area is the most ideal, because that means it's about 2 to 3 sales per community, and prices are rising just ahead of inflation. Very strong markets are really, really strong sales per community, and price increases are coming every month or with every new release. So that's an incredibly volatile market. Slow market conditions mean sales are not very slow. It's also a weaker pricing environment, and builders are having to employ bigger use of incentives to drive down that inventory. Or we're seeing instances of discounting or outright price cuts, which we don't want to see the builders have to do. And you can see some of those stronger growth markets, excuse me, are in the Midwest. We're seeing that in the Midwest and Southern California. And some of the markets that had been traditionally very strong over the past several years, even during the latest downturn, Florida, for example, Texas, the Southeast in general, we're seeing some slowness in those markets. And we think that's really a combination of the number of the amount of production that was seen in those regions and the number of unsold finished inventory that's in those markets. And we're seeing greater concessions made by builders in these regions. Nevertheless, we do think that those are still growth regions. So thinking specifically about Florida, Texas, the Southeast, Southern California, those are areas that we do expect to have positive job growth. We expect to see income growth in the coming years. And the reason we think that, and the builders are thinking that too, is because we have insight as to where builders are planning to build communities. So where are they building new communities? Where are they planning on expanding communities that they have? And we can see this through land purchases. We do track land purchases, and you can see some of those kind of weaker areas today are still areas where builders are planning new communities. So you see some strong growth in Texas and even in Florida. So we're very optimistic that the long-term growth trajectory is pretty positive for these regions despite near-term slowness. Another area that we track, and we've been tracking for a number of years now, is build to rent. So these are homes that are built specifically for the purpose of renting them out. And based on census numbers, the build to rent number is approaching about 10% of single family starts, and that's more than doubled since 2022. Reasons for that are really affordability. So as mortgage rates remain high, and we do expect them to remain high at least through 2028, that's really pricing people out of home ownership, in addition to a preference of renting versus actually owning a home. But the build to rent market is driving a lot of the single family starts that we're seeing, and we do expect that to continue. Our work with the build to rent developers also gives us insights into what types of homes that are going into which communities. And this is kind of a heat map based on the types of homes that we're seeing. And you can see large clustering of build to rent communities in the Southeast, the Sun Belt regions. Really no surprise, as those areas have increased population, but also in the Midwest. But you can see there's a difference in the types of homes that are being built in these communities, from single family detached to horizontal apartments, townhomes, mixed use, or then single family row homes. So it's really important to understand, the type of product that's being put into these communities so that we can better understand the product usage that will go into them as well. We also ask builders each quarter for insights on construction costs, and we're seeing a significant deceleration of construction costs and building materials across all product categories, really since the inflationary period that ended early 2023. They're still saying prices are up about 1% on a national average, on a weighted average basis, and you can see the various product categories here. So relatively benign material inflation, wait and see what the tariffs do. Our work with the tariffs really is showing that we do expect to see probably low to mid single digits across many product categories that do have heavier foreign exposure. But for now, builders are reporting relatively benign inflation in building materials prices, which does help them solve for affordability. Looking at the apartment side, we say that the apartment market is really a state of deferral. So we have a survey that runs each quarter with apartment developers and building owners and operators. And so these three pie charts show the units under construction, the expected apartment deliveries over the next 6 months, and then the expected starts over the next 6 months. And going right to left, we can see 60% of the survey respondents said they're not planning on starting any units over the next 6 months. 20% said 1 to 100 units, and a smaller percentage more units than that. Expected deliveries, also over 50% say they're not expecting to deliver any more units over the next 6 months. So that gives us clues on where apartment construction is in cycles. And we can see that, you know, a lot of deliveries are probably more than 6 months out, just based on what they're telling us. And the units under construction, you can see here the breakdown too. There still are, to that other point, there still are a lot of units under construction that have yet to be delivered. Longer term, our view of new housing is very optimistic. We think as we're sitting here today, I've shared a similar chart like this in the past, but this is from our latest demographics report that just came out last week. And we think we need about 1.2 million additional homes to return to balance. So we believe that we're continuing to be in a undersupplied situation. You can see, you know, 2001, beginning in 2001 through roughly 2013, we were in an oversupply situation, obviously coming out of the GFC. But since that time, we've been undersupplied. And I think the previous version that I showed was 1.3 million. So we have made a little bit of headway there. But we think that that's about 500,000 for sale units too few, and then 710,000 units for rent. And these are dwelling units. So this could be a single family home. This could also be a single family rental. It could be a townhome, apartments. We think there's about 1.2 few vacant homes to return to this balance. And the way we break that down is we look at household formations, we look at second homes, we look at tear downs, and then this additional vacancy that we think is needed. And so we think that with households being formed, and we have some buffer areas in here depending on immigration. And my next slide is going to dig into that a little bit deeper. But we think that there's a number of households that are going to be formed. We think that there's still going to be demand for second homes. So that is still a driver in the market. People do still want a vacation home or a beach home somewhere. We also think there's about 2.3 million homes that are just in such a state of disrepair that they need to be torn down. They can't be fixed up. They need to be removed from the market. And so to return to that balance, we think that we need about 1.2 million homes per year to return to balance. And that leads to 13.4 to 15.6 million, depending on immigration. So looking at the immigration, the policy shifts that we've seen so far in 2025, we think that's going to reduce rental housing demand primarily, but also for sale. And so our baseline forecast, that 1.2 million that I showed earlier, those households formed per year, that's our baseline. And we anticipate that net immigration between 2025 and 2028 is going to be about 560,000 per year. And then between 2029 and 2034, we expect that to increase to 1 million per year. And that kind of breaks down into what we think is 800,000 owner households, so people that are actually going to own homes, and then 350,000 renter homes per year. If we take a more pessimistic scenario, and we say the policy decisions are going to continue and they're going to actually become more stringent than what we've seen so far in the first couple months, and just say zero net immigration, that still leads to 1 million households being formed per year. So just because of where the U.S. population is in the age of life, we're seeing, obviously, you know, we've talked about the millennials being the largest generation. They're getting into household formation years, and that's leading to owner households, in addition to boomers staying in place and that slack that I talked about not really coming online. Even if we have zero net immigration, that's still 1 million households per year. If we took an even more pessimistic scenario and we said there's going to be elevated deportations through 2028, and we just roughly said there's about 1.2 million deportations per year, and then 2029 to 2033, zero, that still is going to lead to 940,000 households formed per year. Again, due to the demographic shifts and people where they are in the stage of life forming households. And that would equate to roughly 760,000 owner households and 180,000 renter households per year. So what that looks like is we think that the long-term demand from that previous slide that I showed is going to range from 1.34 to 1.56 million new homes per year for sale and for rent. And this outlines the various scenarios that we see. So keep these numbers in mind as we look at the household formations and the number of housing units needed and where the housing starts number is. We just got a report earlier this week. I think it was about 1.5 for February. So the way that we've been building, the way that we built through 2024 and extending into this year, it still is not keeping up with our most pessimistic scenario. So that is why we're longer term, we're very optimistic about housing demand just due to the undersupply that we have today and the population growth that we're anticipating over the next 8-9 years. So with that, I'm going to dig into repair and remodeling market a little bit. We see that 73% of outstanding mortgages are still at fixed rates below 5%. And we can see 21% are still below 3%, 55% are below 5%, 73% are below 5%, and then 83% are below 6%. And with mortgage rates still being well north of 6%, although they have come down in the past several weeks, you can see that 73% or 83% below 6% are still locked in at these rates. We do think that we're past prime lock-in effect, if you will, just because there obviously have been mortgages underwritten over the past couple of years when mortgage rates were higher. So this peak lock-in effect that we may have seen in, let's call it the fourth quarter of 2022, that's passing. But nevertheless, we're still seeing that impact, and you can see this in existing home sales, although the number that we saw in existing home sales this morning was more positive. But this lock-in effect is prevailing. It's still the prevailing force. People are staying in their homes longer just because of the low mortgage interest rate that they have. And we can see a record high of 86 million homeowners stayed in place in 2024 just because of those mortgage rates. So the historical average is about 4 million annual movers, and we've seen that come down precipitously since 2022. And the number of households, U.S. owner households that did not move continues to increase. That's positive for remodeling. People are in their homes longer. Building products are in the homes. They need updated. They need repair. And so we think that once we get some certainty around interest rates and that prevailing effect of the lock-in effect is going to continue and contribute to home improvement. We have a couple of remodeling surveys. This is from our U.S. Remodeling Index, where we survey roughly 700 professional remodelers on a quarterly basis. And we have an overall index, and we track things like the near-term activity gauge, which is really the next 3 months. We track their current activity, so what are the projects that they're doing right now, and then the demand meter. So how high of demand are they seeing from homeowners right now? And we started to see an inflection in the fourth quarter of last year, which is our latest survey reading. We'll be sending out the first quarter one here in a few days and have a reading on that by the time we speak next time. But we're starting to see an improvement. We're starting to see initial signs of demand recovering. So that tells us that lock-in effect is in place. People have been in their homes and realized that mortgage interest rates are not going to come down near term. So they may as well just stay in their home and then fix up the home and make it the home that they want versus moving into a new home. And we're seeing an improvement in responses to higher interest rates. So this is a comparison. The dotted lines are from the third quarter survey that we did, published at the end of last year. And the green is the results from the fourth quarter. And we can see in the third quarter of last year, 38% of the respondents said that homeowners are pausing or delaying a project until a future date in response to higher interest rates. We saw that come down to 28%. They said only 28% of homeowners said that they're really going to pause just due to interest rates. We're seeing improvement on that they're spending less on projects, borrowing less money to fund these, downgrading product offerings. So what we're seeing is a continual improvement in these readings as a consumer response to higher interest rates. And we have a quote here from a design build remodeler that says, their vantage point, consumers are staying in their current home and requiring a cost analysis of what a major remodel would do versus buying something new. And they're coming to the conclusion that because of interest rates, it just makes more sense to do a larger remodeling project versus move into a new home. They're starting to see an increase in inquiries too. So we started to see strengthening. So 56% of remodelers reported that they're receiving normal or above normal inquiry levels. And again, there's a quote down here, representative saying that they're starting to open back up to the opportunity to remodel. And they say that it's the economy that stopped them. Now that they see, where things are with the economy, that they're more inclined to undertake remodeling projects. That's leading to higher inquiries. Now, this was obviously all before the change in administration and the policy decisions and the consumer sentiment falls that I showed earlier. But still, at the end of last year, we were starting to see a positive inflection. And they also reported backlog growth. So they said 6% of them said that their backlogs are growing or their backlogs are up versus a year ago. And this time series goes back to the first quarter of 2023. So we're seeing an increase in backlogs. Remodelers are saying they actually have more projects in their pipeline than they did a year ago. So that's indicative of the demand that we're starting to see slowly in remodeling. I showed this slide previously, some of you may have seen it, but this tracks a correlation of household net worth versus growth in homeowner spending on large projects that cost $30,000 or more. And that green line is the increase in household net worth, and that blue line is the total homeowner spend on large $30,000 and above projects. We can see there's generally a correlation. When household net worth increases, then we do after a while see an increase in these large ticket remodeling projects. And so we've started to see household net worth growing. And this household net worth is a calculation. It could be equity that homeowners have in their homes, stock market portfolios, 401ks, et cetera. But we have seen household net worth increase since the end of 2023. And we do think that that is going to end up driving some of these bigger remodeling projects. And a quote from a kitchen and bath remodeler here says, seeing more higher end projects versus lower or mid remodels. Clients can afford the high end products or they're not going ahead. So what we think that a lot of this remodeling growth that we expect to see is going to be driven by these high-end consumers that have the financial means, they have the cash, that they're able to invest in their homes, and we expect that to kind of lead the recovery in remodeling. This is from our kitchen bath survey, and we see that 40% of design firms said project scopes are actually getting larger. So the share of the design firms reporting higher price points and higher product grades is increasing. And there's the representative quote saying that they're ready to begin even bigger projects in 2025. And so when we look at, we asked the remodelers too, are there more trade downs or more trade ups? Meaning, are people downsizing their project size because of product costs and overall project costs? Or are there more upgrades because they want nicer materials and they figure that's more reliable? And you can see the left is the consumer shifting to higher grade product price points, and the right is consumer shifting to lower grade price points. And we saw a decline in the fourth quarter of consumers shifting down, so trade downs in product quality. And you can see another representative quote from a window contractor from our survey in North Carolina. More and more homeowners looking to upgrade and update the looks and efficiency of the homes. Today's homeowners are not looking to sell and move like we saw 2 years ago, right after the pandemic. So again, to that point of higher for longer mortgage interest rates, homeowners staying in their home longer, they're realizing that they're going to be in their home longer, and it's better to invest in their home as a sound investment as we continue to see home price appreciation. So we're kind of back to parity, what we call set point. We're seeing an roughly equal number of trade downs than trade ups. So that's good news, and that's another reason that we think that we're going to start to see a thaw in the repair and remodeling market this year. I showed this slide the last time, but I think it's still relevant. We do expect record spending on disaster repair in 2025, just due to the number of storms that we saw last year. A significant number of storms and the hurricanes in parts of the country that generally don't have these types of issues. The recovery for that is generally extends out to 24 months. And we think that we're going to continue to see a benefit from that storm damage recovery as we move through this year. And even over the next couple of years, we think it's going to be at elevated levels relative to history. So with that, I'm going to go into our insights from the latest window and door market survey. This will outline the fourth quarter results. So what window and door manufacturers, installers, and glaziers and glass shops told us about their fourth quarter results. Just a little bit of a background. This is the exclusive partnership between Window and Door Magazine and John Burns Research and Consulting. It's a quarterly survey of manufacturers, glass shops, glaziers, installers. We measure volumes, revenue, lead times, backlog, supply chains, and then forward-looking guidance for what they're seeing for the next quarter, as well as as the full year. And it's really a quantitative data. So we look at quantitative on percentage basis. What do they say? Orders and volume and revenue were up year over year and quarter over quarter. But also we get a lot of good qualitative commentary. It really helps us fill in the gaps. So we look at what the numbers say, but then what are the things that the numbers don't say? And that's really the qualitative commentary that we get from our participants. And so I do want to emphasize in this, if you don't already participate, number one, we have a QR code at the end of this, so you can sign up to participate in the next survey, which we'll be sending out in a couple weeks. But what we do, we know that the fenestration industry is very sensitive and highly private. And so we always want to emphasize the anonymity and confidentiality. We never can track back who said what. We never track back to actual results to the company that reported. That's really to ensure that, you know, the data and the comments that are reported will never get tracked to, oh, company X said this, and that could be used as competitive advantage. We rule that out. I don't have visibility into that. Window Door Magazine doesn't have visibility to that. So we really anonymize everything. So you can respond with confidence because we do ensure that confidentiality, and we just lump everything together to come up with the numbers. So digging into 4 key survey takeaways from the fourth quarter. Fourth quarter ended up being stronger than anticipated at the end of the third quarter, but expectations are coming down for 2025. Shipments and revenue were higher in the fourth quarter, but they've lowered their first quarter 2025 forecast, starting to see accelerating material and labor inflation. We're starting to see more focus on some of these customer-centric approaches to drive demand, understanding that the market may be a little bit soft and this 2025 may be a challenge. We asked about what steps companies are taking to really drive demand for the rest of the year. And then again, as I mentioned, diminished 2025 expectations. So in the fourth quarter, 55% of companies reported volumes growing across all companies. And on average, volumes grew by 2.2%, which was the strongest that we'd seen since the second quarter. And despite weather events and despite some seasonality, companies did report stronger volumes in the fourth quarter. And that also led to revenue increases. 55% of the respondents said that the revenue increased year over year in the fourth quarter, and on average, revenue was up by 3.7% year over year. So we could see it was kind of a making up for lost ground. We could see some red in the first and second quarter of last year, relatively flat revenue growth in the third quarter, and then we did see year over year revenue growth in the fourth quarter. But again, that was comping revenue declines that we saw in the fourth quarter of 2023. We asked about their direct costs, specifically around materials and around labor. And we did see an acceleration of input costs in material, went from 3% in the third quarter to 6% year over year in the fourth quarter. And direct labor costs also increased slightly in the fourth quarter. Material increases, we think a lot of that was kind of pull forward from potential tariffs, specifically after the outcome of the election was relatively certain. We think that there was a little bit of pull forward in some of those material price increases that took effect at the end of last year. And then direct labor continues to be tight. We're hearing broadly that, you know, it's become somewhat easier to find labor, but labor is still a challenge. And manufacturers and installers still have to invest more in their direct labor costs. Looking at backlogs, we saw 40% of companies reported decreasing backlogs year over year in the fourth quarter. Another 40% said it's roughly the same, where 20% of the respondents said that their backlogs were increasing. So that gives some clues into the forward guidance that we'll take a look at in a minute, because you see the backlogs are decreasing, that pipeline is kind of drying up a little bit. And so that's giving some insight as to where they think the market is headed as we're into early 2025 and then throughout 2025. We've asked about material lead times. So these are the materials that we asked the manufacturers of the materials that go into them. Are you seeing any product shortages? Obviously, through COVID, coming out of COVID, we had supply chain issues. But for the past several quarters rather, we've seen most manufacturers say there's really not a ton of issues. So 69% again this quarter said there really were no product issues with the supply chain, that they had issues getting that. Very small percentage said float glass, IGUs, aluminum, or hardware. But this is such a small percentage, I probably wouldn't weight that too much. But 69%, roughly 70% said there are no issues. We're able to get the supply that we need to finish our products. We asked them about shipment expectations for the first quarter of 2025 versus the fourth quarter. And here you can see diminished expectations. About 45% of them said that they're expecting to see roughly the same number of shipments this quarter versus last. 27% say they expect shipments to grow. Another 20% said fewer shipments. And then if we weighted average everything together, you can see declines of about a 0.5 percentage point in shipments quarter over quarter. So first quarter of 2025 versus the fourth quarter of last year. And we asked about revenue. 45% said they expect revenue to increase, but really on an average basis only by 1.4%. So relatively flat revenue growth anticipated for the first quarter of 2025, quarter over quarter versus the fourth quarter of last year. Looking at full year, and 73% of companies said they're expecting to raise prices in 2025. Again, this was before the impact of tariffs was calculated, but we said 73% said they're planning on or have already announced price increases, and the average price increase was 3.6%. I do anticipate this number coming up depending on the impact of tariffs and the components that go into Windows. But this is a kind of a normal price increase environment. So we're not seeing the crazy price increases that we saw in 21, 22, and even into 2023. We're kind of in that normal average annual price increase range, kind of pre-COVID norms, if you will. But I think the expectations, we saw it on the previous slide from building materials dealers, they anticipate that being a little bit higher. And then depending on the impact from tariffs and the inflationary impacts that may have, we do expect this may creep up a little bit. So it'll be really interesting to see what next quarter's results look like once we do get some certainty around the tariffs. Most of the companies are expecting an increase in shipments for full year 2025. 64% said they're expected to ship more units this year than last. And shipments are expected to increase by 5.6%. In this slide and this slide here, where 91% of companies expect full year revenue to be the same or higher, and revenue expected to increase on average by 7.7%. I wanted to spend a couple minutes on this because we had similar results when we asked the same question this time last year. And what we saw was going into the year, the companies were more optimistic about how the year turned out. And then those expectations were not met as we moved through the year. If you think back to the time series charts I showed previously, expectations were, revenue decline, unit shipments declined too, but they came into the year pretty bullish. This is a pretty bullish read, 7.7% revenue increase. I admittedly think that this is pretty bullish. This industry is very optimistic, which is a great thing. It's a good quality to have, and I think if you're in a position you want to be more optimistic about the outline or about the outlook rather. But we think this is probably bullish, and so we're going to be monitoring this as we move through the year because we do expect these expectations to come down. We also asked about employment plans, so production and sales and marketing workforce, and we saw 50% said no changes planned, and another 50% said adding to production workforce. This is another one too. I know there was a lot of news articles, and Window and Door Magazine highlighted some of them about some plant closures, some layoffs of some of the manufacturers. So this is strictly as reported. We're not going to share who reported what, and I don't have visibility to that. But we think that this is either it was the timing because layoffs and closure announcements have already been made, but they're reporting 50% said they're planning on adding, with another 50% saying they're not planning to make changes to their production workforce. And then looking to sales and marketing, 75% of the respondents said they're planning on adding to sales and marketing, with another 25% saying not planning to make any changes. You notice this slide and the previous slide, 0% of the respondents, none of them came back and said that they are planning on reducing workforce. Either that's because it already happened or there really aren't any plans just because of the growth plans that many of our respondents have. So when we ask about what are the main focus areas, we do ask each quarter of the respondents, especially on the manufacturing side, what's the number one area that your company is going to focus on across all of these different selection criteria? And 30% said again this quarter product automation. When we first started this survey in the third quarter of 2023, that was the leading response rate. Last year, we did see more companies say that they're really revolving around energy efficiency and code changes. That was the number one area, and so now we've reverted back to production automation. So again, thinking about cost structure, thinking about efficiencies, thinking about a potentially soft market, and how to really improve the cost structure and drive productivity, it was really no surprise for us to see the number one response was around production automation and really simplifying production and making it less costly to manufacture. Another 15% around design styles, ADA, ease of operation, and also footprint expansion, enhancements for easier installation, and then impact resistance is obviously that's still a focus area in certain parts of the country, especially in those hurricane-prone regions. We asked around, what steps are you taking to really drive sales this year? So understanding the market is going to anticipate to be a little bit soft through 2025. What steps are companies taking? And the number one step is really increasing sales training and education for sales resources, really being able to outline the value proposition of why their product is better and be able to be more effective in their sales process. Seeing an increase in B2C marketing, expecting an increase in and new business development, B2B, so reaching out to new builders, reaching out to new contractors, distributors, et cetera, expanding sales territory, so just growing the overall footprint. And then several is really, other, which could be anything really, or none of the above. And then a smaller percentage saying, increasing discounts or price matching competitive quotes. That's kind of always been in the marketplace. But I thought it was really interesting, this training and education for sales resources to really drive some of that market, to drive outsized growth in the market. And here's some of the qualitative commentary that I highlighted that we get each month. And you can see impact of tariffs. That was a big thing. Impact of tariffs, interest rates not going down, housing prices not going down. The threat of tariffs was already affecting consumer behavior. Point around labor continuing to be a struggle, weaker demand, I think, in the fall, just due to the election, people staying in their homes and getting home improvements. So again, to that point earlier, people locked into those mortgage rates, staying in their homes and continuing to upgrade their homes. And then really looking at different business areas. So be kind of like diversifying the business to carry through the ups and downs of new construction, move forward with new projects, to open up room for revenue growth in the second and third quarter. And really it's about keeping that dialogue open with customers. So understanding what their customer needs are, understanding their customer pipeline, and being able to plan around that to keep those backlogs and keep those cycle times in check. So with that, I'll get to a few key takeaways, and then we should have a few minutes for some Q&A. So just to recap, this economy is what we're calling like this wait and see mode. Economic growth is slowing. The threat of a recession is looming back. We hear some from the Fed commentary yesterday about maximizing employment, reducing inflation, but there may be outside threats to inflation just due to the tariffs. And consumers are really reining in their spending. And we think that slowing immigration is going to impact household formations near term. And that's also contributing to a slowness that we're seeing in housing. The new construction marts, the spring selling season hasn't really sprung yet. What we're hearing from the builders that we talk to, single family builders are continuing to slow their starts just due to that unsold inventory that's on their books. Multifamily is remaining pressured. We expect multifamily to remain pressured throughout this year. But longer term, the U.S. is continually undersupplied by about 1.2 million units, and we do expect housing demand to increase through 2034, just based on population numbers that we're seeing. The R&R market is in a state of deferral, but we're starting to see some thawing in that. Backlogs are starting to grow according to the remodelers that we talk to, and fewer consumers are really citing canceling projects due to cost. We think that the remodeling turnaround is going to be led by higher income, wealthier households who are more resilient. They have the cash on hand to pay for these projects. And we're seeing the number of trade downs roughly equal to trade ups, which is a shift that we've seen over the past couple of quarters. So that's good news. The ever optimistic window and door companies do expect volume and revenue growth in 2025. Better than expected fourth quarter results when we compare that to the third quarter results last year, and solid expectations for the first quarter, but we have seen expectations for full year come in. So they were very optimistic for full year 2025 when we asked this in the third quarter, and they've come in a little bit. Still pretty bullish, as I mentioned, and we think that a lot of that's driven by the inherent optimism in this industry, but they have come down a little bit, and we'll be monitoring that in the next survey and what the respondents say, how their outlook may or may not be changing. And so near term, we do expect challenges to remain for new construction and for R&R just due to the macroeconomic uncertainty and changing policy. We do expect a turnaround in the repair and remodeling market later this year. And longer term, we see longer term growth fundamentals really solid for both new construction and R&R. And with that, this is a QR code. If you don't already participate in our window and door survey, please scan this, or here's my contact info. You can send me a note or give me a call if you'd like to participate or have questions in general that you don't want to address here. But this code will take you to a sign up page. And as I said, we'll be sending out the next quarter survey here in a couple weeks to get the read on the first quarter. And so with that, I think we can open it up for some Q&A. I think we have about 10 minutes maybe.
Thank you, Chris. We do have several questions that we can get to. The first is a clarification question about companies investing in production automation. The person asking the question wondered if production automation includes both hardware, such as robots and machines, and software.
Yeah, it's both. So we don't really differentiate between robotics, if you will, and just software upgrades to existing machinery. It's just kind of general automation, but it does absolutely include both. And I can tell based on some of the qualitative responses that software is a piece of that too.
And then we have a couple questions here on tariffs. Lumber from Canada was mentioned, but won't tariffs on aluminum similarly cause significant impact on window and door companies' material costs?
Yeah, it absolutely will. I think we had a day of tariffs so far this year, and I think they were announced, and then there was the carve out for the USMCA products that fell out of the tariff exposure, if you will, again until April 2nd. So the next deadline is April 2nd. As things stand today, we're fully expecting those carve-outs for USMCA products, which includes lumber. It also does include aluminum, to my understanding, for window and door companies. We do expect that. Well, I wouldn't say we expect it, but as things stand today, it is expected that they will come out of that. So that will be exposure. So yeah, I mean, from a manufacturer's perspective, obviously, I'm sure you all are doing this, but looking at your overall cost structure and where products are coming from, aluminum from Canada absolutely will be in that tariff. So depending on the percentage of your COGS that go into your products with aluminum exposure, but also wood exposure, if you're getting hardwoods or softwoods from Canada, that is anticipated to be in the April 2nd tariff.
Along those same lines, have you seen companies looking to bring some of their suppliers into the US if they currently have overseas suppliers so that they can avoid some of these tariffs?
We are seeing that. So in talking with a lot of the home builders recently, as well as some of the manufacturers trying to onshore some sourcing, it depends on the product category, and it depends on the level of supply too. So this is obviously something that can't be done overnight. You can't just you can't. It's very unlikely that you're able to replace one for one a supplier that may be based in Canada with a supplier in the U.S. These agreements take a long time. Factories, if they're not already in place, need to be set up. I think what caught a lot of people, I'll call it by surprise or a little bit different, was there was talk in the election of the 25% tariffs on Canada and Mexico, but I don't believe there was widespread belief that would actually happen. It would be used more as a negotiating tactic. And so we did see across many manufacturers shift a lot of supply from China to North America, and that could be Mexico, it could be Canada, it could be the US too. So I think that the inclusion of Canada and Mexico is really what caught a lot of manufacturers by surprise, that these products are actually included too. Like I said, TBD as of right now, April 2nd, they're going to go into place. And as I think everybody should plan around that happening, and if it doesn't, it's more upside surprise. But yeah, there absolutely, we have seen a diligent effort really since 2017 for manufacturers to move sourcing out of China to North America or to other parts of the region, other regions of the world without as much tariff exposure. But the Canada-Mexico piece of it is still, I think, a more difficult pill to digest, if you will.
You mentioned that R&R spend will be led by high-income households. How much risk is there if equity markets keep declining? If equity markets decline an additional 10 to 20%, do higher income households delay their previously planned projects?
That absolutely is a risk, and over the past couple of weeks and next week too, I'm speaking with some of the luxury and high-end design firms. So these are primarily R&R focused, but they're luxury design. And what I heard in the fall and what I heard these past couple of weeks is this is a market. They have the financial means, they have the cash to pay for these large projects with cash, but with the way the equity market has been transpiring and just the overall consumer uncertainty and overall macro uncertainty, even though they have the cash, even though they could do this, we're starting to see that being paused. So the luxury high-end market was kind of later to enter that downturn, and everybody I've spoken to said they hadn't really seen downturn in that specific market segment till, call it, spring or summer last year. But it's a little bit in deferral too, and it's really just kind of that wait and see of let's see where the overall economy is headed before investing that money. But I also think that they're probably going to be one of the first ones to say, once we do get clear signals that the economy is turning around and that there is signs of improvement, I do expect that that segment to probably be one of the main drivers of the recovery in R&R.
Do you see similar trends in the commercial construction market?
Commercial is, we don't really cover commercial that much at John Burns. We're primarily residential focused, but by and large, we talked about what some might consider commercial, so apartments, multifamily, but office and retail, that's kind of been pressured for a number of years now. But we're still seeing growth in some of those like data centers and logistics hubs. We do continue to see growth there and expect that to continue as well. Obviously the financing has to make sense, but if the deals can pencil based on construction loans and loans to build. And then, if you got a tenant and what the rents are going to be, then it may make sense. But it's kind of like, those two industrials, data centers, logistics, that continues to grow, but seeing weakness in the other categories still.
It looks like we are at time. I see we have another question from Peter in the chat. So Peter, we will take note of that and address that offline. Chris, thank you so much for your time this afternoon.
Very good. My pleasure. Thank you, everybody.
You're welcome.